Hey guys, Mike here. So, oh boy, what a big green day yesterday, but it wasn't just the Qs this time, right? They actually took a back seat. What have we been talking about for a couple weeks now? Rotation, rotation, rotation. And it's very important to follow that. So I'm going to show you the charts of what I'm talking about and see if this is the start of something new. We'll get your opinion on that. Also, we're going to talk about student loans because this new debt ceiling deal, which should be getting signed this weekend, will affect that. And this is going to be big because we're talking about a very big bill that will have to start being paid back very soon. And then we'll go into a couple more charts to look at, which are important. But, you know, unless you live under a rock, you probably noticed we had a big time hot jobs report come out yesterday, right? I mean, created a boatload of jobs, twice as many as what they were forecasting for. The unemployment rate did go up to 3.7. But the most important stat to me was the participation rate for 25 to 54-year-olds. Like, this is the key right here. And you can see it reached a level we hadn't seen since 2006. So these folks, for whatever reason, have started flooding back in and taking jobs now. And so I don't know where they went, but they sure are coming back in droves over the last few months, right? And that is important because I've done a whole video on talking about that demographic right there is actually projected to be shrinking in the near future because, wow, we're just not having as many kids and stuff, right? And then people are just, I don't know, starting YouTube channels and Twitters, and they're not going actually into the regular job force, or they're becoming traders or something. But, you know, they're coming back in droves now. Put in the comments why you think that is and stuff. I did read a report saying that people had retired earlier coming back in. And not really sure why that would be, if it's because rates are higher or whatever it is, but that's what's happening. So that was a key thing. And of course, this goes to the narrative, what do we talk about? Soft landing, right? Where everything just kind of lands out perfectly. The rates don't do as much damage as they thought it would do. The labor market actually stays intact and everything. We don't go to 5% unemployment and stuff. And so that's really the narrative that was painted yesterday, right? Oh, this means we're going to have a soft landing, right? Which they've done once in the history of the country, but we'll see if this is number two right now. With the debt ceiling, obviously this will be signed this weekend. It affects student loans. Why? Because now part of this deal is that President Biden cannot extend it out anymore. And so I believe it's either August 1st or August 31st, I believe. Put in the comments if I'm wrong on that, of when student loans start to have to be paid back. And this is a big deal because this is the third largest bill most people have, and especially for younger folks, 18 to 29. That's the same group that has fallen behind on car payments by more than 90 days, right? That's going up for them. And so they're struggling right now. Why would they be struggling? Well, because obviously houses are more expensive, rent's more expensive, and most of them are just, either not in college, getting out of college, but working in lower paying jobs because they hadn't even really started their career yet, and they're getting squished with the rate of these bills we have now and how high they are. And the other is going to be 30 to 39, which really trips me out again. I've mentioned this before, is I can't believe there's still people 70 and above with student loans. But, doesn't that just show you how hard it is to finally get your student loans all paid off and how they stay with you? And the important thing about this is liquidity, right? Because if you're having to pay, and here's the averages for an associate, a bachelor's, you can see them. But if all of a sudden you're taking on like a $250 to $500 monthly bill, well, something's got to give. You're either not putting money back for retirement, you're cutting down on, more importantly, your discretionary spending, which is the stuff you don't need. It is a want, right? And guys, before we continue, if you're getting anything out of this, please hit that thumbs up down there. I really appreciate it. And if you like the material here and the videos, think about subscribing. And so instead of going out and buying Nikes, you buy cheaper shoes. Maybe you can let your car last another year or two versus going out and buying a new car, that kind of stuff. And that's the first thing that goes when things get tough, is the discretionary spending. You know that. You do it yourself. I do it. But on top of this, what have you seen happening? This is where all that credit card debt that's being racked up is, mostly between like 18 and 35-year-olds. That's where this is going to come into play, right? I always say it's not a problem until it's a problem, okay? And so again, as long as they have jobs, they can try to make this work. But, for most people, when they have to take on a $250 to $500 extra bill they weren't paying all of a sudden, something's got to give, something's got to go, okay? And so that's what we pay close attention to, especially we'll see how it more importantly affects earnings when it comes to the stock market, obviously. And that's where you're going to hear from your Walmarts and your Targets and your Nikes and stuff like that, and the car companies. saying, oh yeah, people just don't have the kind of money anymore. And so, and it's a lot of money. There's a whole boatload of people, millions, with student loans in this country. Okay, and some of them, some households have a couple has each of them have student loans. So you're talking about double that up, right? I know couples that both of them are going to kick back in at the end of the summer, and they're going to have like $1,000 a month in student loans because they got master's degrees and all that good stuff. And for those who don't know, you just have an associate's or bachelor's. As you go up in degree, you have to pay a higher interest rate. Okay, so it's more money, right? Which is crazy to me how that works. But yes, so just keep that in mind as you continue your education. Now, getting into the stock market, and let us know in the comments, like if you want to share what your monthly payment is going to be, or if it's going to kick in, how you think that's going to affect the market. And that leads us into the IWM, the small caps, which we're going to talk about. We've been talking about this for a couple weeks. And what are you seeing happening right now? You got on the weekly there, you got a MACD cross, the RSI's cross number 50, which is bullish. It made it through that heavy resistance right there finally, but we still got this trend line, which I'm looking at, to try to break out of. But you saw Friday, huge move up. Now, does that mean, hey, we're going to the moon? We've seen it before. We'll have to see if it continues, but understand that was a huge move up, especially, I think it was 3 times what the Qs did. Friday, we talked about that. The Qs have been up a lot. When is some money going to rotate out, taking profit off the Qs, rotating into small caps and stuff like that? And you can see on the hourly though, it looks like the MACD wants to roll over. Obviously, definitely overbought right now. So we could see a short-term pullback and maybe take that supply area and turn it into what? Support, right? So that's what we're kind of looking for. But I talked about this, I guess it was last week or 2 weeks ago. When you see extremes, that's when you usually see a rotation. And when you compare the IWM versus the SPY, you can see, it's absolutely been getting just destroyed. It's actually sitting there at a low we hadn't seen since the dot-com bubble and stuff. Now, what I did find interesting about this chart, you can see before the 2 recessions, even before the 2018 crash that started in October, IWM was getting crushed by the SPY, right? And then, of course, what happened leading out of it, the IWM outdid the SPY coming out of those crashes, which, of course, is not the case right now. But why is that, and what's different about those times? And it's very simple. Let's add the Fed fund rate, and let me show you how it affects small caps versus all the others. You can see right here, plain as day, when the SPY is outperforming small caps, what is happening right here? You can see the Fed fund rate is going up or is staying up for quite a while. Each time you see that, because small caps are definitely affected more by interest rates, right? Because these are a lot of unprofitable companies I'm going to show you, and they take on a lot of debt to keep that growth going and just basically to keep the doors open. As you can see right here, just came out yesterday, 38% of the entire Russell 2000 is unprofitable companies, right? These companies are taking on massive debt. You can see it's actually heading back up, not heading down. And the top, of course, was around, what was that, December 2019, early 2020. It was when the top was. So it's heading back up that way. And you can guarantee with these interest rates, they're probably going to be even more unprofitable, and that number is going to continue to rise. And another, extreme we're talking about is IWM versus the Qs, right? We've actually reached a new low, right? A new historical low. 2001 was the low. Well, we breached that, as you can see. And so another way to look at this, of course, not just a new low, you can flip it around, or you can say, well, look at that. The Qs versus IWM has reached a new high, as you can see. And so when you get to these extremes, that's when you start to have the quant funds and all the computers, basically saying, wait a minute, where are we going to get more bang for our buck here? On the Qs that we've ran up like crazy, especially those big mega cap stocks, or trying to maybe run up the Russell 2000, even though, of course, economically, is it a good time for them? No, but as we've seen, that does not matter, okay, at all at this point in time. Fundamentals don't matter. The metrics don't matter. It seems like they don't care. And so when you look at this right here, what else is the IWM trying to do? It is trying to complete a stage 1. This is a 30-week moving average. Some people use the 40-week. You want it turning up, and you want to be above it. So it's trying to get above it again. You can see it's done it before and failed. Unlike the S&P, right? S&P's 30-week is turned up. It's above the 30-week moving average. Trying to go into it actually is in a stage 2, right? And so NASDAQ 100, same thing. You look at this one right here. obviously well above the 30-week. That's, I think it's 6 weeks and counting of green, right? And so you can see that 30-week moving average is definitely turned up. And so the IWM has not done that yet. It is trying to do that. You know, what else was happening? Obviously, regional banks, once again, trading like penny stocks, a lot of money moving into it, right? And so keep that in mind. And that leads us into rotation, okay? And if we look at this, the last 30 days, what did you see? You saw XLK, XLY, XLC moving up like crazy, and then you had basically XLF, XLE, XLB, XLP, and XLU not looking so hot, right? But then if we go and we look at the 5-day, which would be all last week, you can see a big difference. All of a sudden, you got XLY, XLK, XLC still looking good, but what else is falling behind now, right? Then you end up with XLU, XLB, XLF finally turned up and turning positive starting in June, right? This month, right? So just a couple of days. And that's what we got to pay attention to, because if that continues, right? This is how people knew to get into oil stocks. They started seeing this rotation move in there and stuff. And that's big money, by the way. Big money is what's pushing this up, and then everybody else tries to follow in, right? So you can see that happening. So we'll pay close attention to those sectors to see if that's actually what's happening. And then get into the stocks that are helping, obviously, still helping the Qs have 6 weeks of green, the SPY moving up. Tesla, remember I told you guys, you know, a lot of people are targeting 220, 240. You can see, obviously, above that 200. Overbought like crazy. MACD still has room to run though, right? And if it makes it above that 217-ish, which is the next level, or sorry, 218-ish, then, you know, you can see it's going to the, you know, 220, 230 is going to be rough to get through. But with all the call buying and everything, it can absolutely get there. It's just kind of following that trend line on up at the angle over there, as you can see. Could we see a pullback? Absolutely. It'd be nice and healthy for it, because you can see it ain't been this overbought or above that level since like November 21, which is actually its top. And so can it continue to go on that? Yeah, because when you look at the MACD, you can still see it has room to run, and Tesla is no stranger to being overbought, right? And so keep that in mind. You know, can you see a nice, that'd be a perfect place for rejection around 218? Absolutely, for a small pullback and then continue forward. Now, one thing that's helping it is, I know Elon put this out, that all Model 3s should actually be qualified for the tax credit, so that always helps. And of course, when they've cut prices as much as they have, a lot more people buying Teslas. So, you know, keep that in mind. And it really depends on China. We really got to pay attention to those numbers. Now, Google, watch this. Maybe for a trend change, we'll have to see. You can see, to me, it looks like it's consolidating up, but it cannot get through that golden pocket area, that heavy level of supply right there. And you see down at the bottom, what do you see? A bearish MACD cross. Okay, finally got out of overbought on the daily. But the reason why that's important is because when we look over, when the MACD has a bearish cross right there, you can see it's sold off the last 3 times at least right here, as we can see. There's one right there. Come over here, we'll see 2 right there. And so it's had some decent pullbacks right here when this has been happening. So again, it is in an uptrend. Do I expect some big pull like that? Probably not. But, you know, going back maybe to the 0.5 Fibonacci level around 117 would make sense. But keep in mind, for a long term, this is the monthly. You just had, basically, it's starting to have a bullish MACD cross. The RSI is over 50 on this. And so keep in mind, for the longer term shift, this can definitely continue to move up just like the rest, because it's one actually the cheapest on a valuation level when it comes to those big mega caps, believe it or not. I mean, I don't think that's shocking, of course. The other ones have moved up hugely. Meta, very simple, only 4.69% away from completing that gap. And the question is, will it finally get a breather and come down and fill the rest of those gaps? As you can see, you got the 200 turning up. It is super overbought right now on the daily, even though that, for whatever reason, doesn't seem to matter. But that's what's happening on Meta. Then you got BABA, and this is a prime example of how powerful gaps are, right? Gaps up to fill the gap, hits the very top of the gap, and completely sells off the rest of the day right there. But, you know, what are you seeing right here? Obviously, it got overbought on the hourly, so it just sold down. MACD looks like it wants to roll over short term, maybe go down, fill that gap it just created. And, you know, to me, it's pretty simple. In the daily, obviously, it had a bullish MACD cross. RSI is now at the 50 level, starting to creep above it. And when you look, it's all about that trend line to me, because, you know, we've been here before with, obviously, China announced they're doing stimulus and stuff like that. But that trend line right there is what I want to see it break. I think if that breaks, it's going to be super bullish for it. It's getting very close to it. But again, this is a lot of talk about more stimulus in China because their economy is hot garbage. I mean, there's nothing in there that shows there's a lot of growth or anything. And so, and I'll show some of that tomorrow, because remember that their economy, or their it isn't about the stock market, right? It's about the real estate market, which I showed you is just an absolute mess right now, right? All those ghost towns they built, people buying empty houses because 70% of their worth is in that real estate market. And that's why they're ordering those banks loan, right? And so it helps to obviously be able to run your state banks and stuff like that, or your banks in your country. So unlike here in a way. And so they can keep that thing propped up as long as they want. But again, the growth isn't there. That's why you see a lot of companies, Apple and others, flocking to India, right? Because they're obviously, I think India isn't the most populated country in the world, I think it is. But, they're starting to evolve and stuff. And so people are really trying to bank on India for more and more growth. Because I think they kind of see the writing on the wall in China and stuff, and the way they've gone and everything. So, but again, we'll have to see, because the earnings haven't been that good coming out of the country or anything. So, again, we'll have to see how that works out and stuff. But, just understand, again, we don't have the full picture of what is going on in the economy. I think once we finally get student loans kicked in, all the COVID policies go away, right? And so that takes all, any kind of extra liquidity out of the market. That's going to take more liquidity out of companies' hands, right, for earnings, because now you'll be paying student loans again. Then we kind of get to see all the cards on the table, right? And if they keep interest rates higher, which of course I think they pretty much know they're not going to raise in June. They pretty much sent that message out, right? So the stock market's seeing that and going, yeah, buddy, right? Remember, it's an addict, and what do they love more than anything? When it's a pause, here we go. Moving up, soft landing, all right, which may be possible. But then maybe they raise in July or something. I mean, that's just a hot mess. But we'll see how that affects it, because seasonality-wise, summer's never been super great for the stock market, especially, we're running up like crazy right now. But for me, it's all about, and what you should be looking at, is rotation. Are we going to really start to see a rotation out of a lot of tech stuff just for profit taking? Not saying they're dumping their whole position and getting out, but they're way up, securing profits, rotating that money down, still holding a big position in the mega caps and things like that, right? And so that's what you got to pay attention to. Again, I'll do a video tomorrow and stuff, setting us up for the week, more charts and everything. Earnings coming out, which has a lot to do with our spending, things like that, and stuff like that I talked about earlier. So if you got anything out of it, guys, hit that like, subscribe button, give it a thumbs up. I really appreciate all you guys who watch the videos and share the videos. It means a lot. And so next week, back to normal, okay? So see you tomorrow.